Hey, good afternoon, everyone, and thank you for joining our webinar today. Today, I have with me Erin Crawford, who is currently the president of the IBBA and started her career here at Transworld, was an agent for me here in South Florida. The reason I asked Erin here to do this presentation today is because I think the CapEx issues with depreciation is super important, and we see it a lot come up where it messes up one of our deals. And to be honest, when I have questions about CapEx, Erin's who I call. So, because all of the deals that she deals with at this point in her career all have some sort of CapEx equation in it. And, quite honestly, she's just better at it than I am. So I went and found the best person I could to talk about this with you guys. And I will go ahead and turn it on over to her
Fun
now.
stuff.
Yeah, good stuff, right?
Glad to hear. That's probably the only person that said that. So, well, nice to be with you guys today. Probably I did meet most of you at the conference. So really excited to talk about CapEx today. But before we do that, I'm going to go ahead and click through. You guys have my contact information. But we want to let you know the IBBA next conference is coming up in May of next year. It is not Mother's Day weekend. It is not Memorial Day weekend. So nobody has an excuse. Be there. It's and Minneapolis, Minnesota. And I believe the room blocks are going to go up, I think, in the next couple of weeks. So check back on the IBBA's website for that to reserve your spot. So hopefully we'll see you there next year.
And I will tell you, Minneapolis is a fabulous city. Really, really enjoy it. Restaurants are spectacular. A ton of things to do in Minneapolis. So it should be a really great conference.
Yep, that'll be awesome. All right, so now we're going to get into this fun topic of capital expenditures. Now, we don't really talk about this too much when we're talking about traditional Main Street businesses. And the reason being is when you think about a restaurant or a hair salon, there's not a lot of significant equipment investments, right? When you start to see this, you look at asset heavy businesses where there's a lot of vehicles, there's a lot of assets that need to be replaced to maintain that particular business. So when we're talking about recasting originally, we're really looking at our traditional formula of calculating SDE or seller's discretionary earnings, right? Where we're taking all of our net income, our add backs, and then we're adding back depreciation and interest. And then we've got some of the other things in there. Well, obviously, when we have depreciation, we just automatically think of that as a non-cash expense. But today we're going to talk about how that actually activity derived from depreciation actually are a cash expense when we're talking about capital expenditures. So, by definition, CapEx are funds used by the company to acquire, upgrade, and maintain physical assets such as property, plants, buildings, technology, or equipment. So, there's really two buckets of CapEx. We have required for daily operations. These are the things that need to be maintained to preserve the economic benefits that the business already produces. So, things that are driving the profits right now. Then you have new projects or investments, future capital expenditures required to provide a future benefit. So I call those potential drivers, right? When we always meet with a seller and they say, but there's so much potential. Well, there's going to be an investment needed to increase the potential for that particular business in revenue and profits. But today we're going to focus on the stuff that is required for daily operations, the things that drive the profit that we're recasting in the financials. So I have this question here, and I would love for all of you to answer, but I think there's too many of you, so I'll present it, but then I'll answer it. So why does this not show up on the P&L as an expense? Well, if you think about it, you're buying assets, right? Where do assets show up? Hopefully, all of us can answer that they show up on the balance sheet. But what is used to buy assets? Cash. So cash has to come from somewhere. It's either going to come from retained earnings or profits of the company, but we have to factor that in on the year that it actually happens. So depreciation, hopefully you guys all know what depreciation is. This is the definition. I'm not going to read it. But I do want to note that it reflects the reality that assets will lose value over time. Things will need to be replaced. And they don't necessarily have to be replaced every single year, but we're going to take a look and see instances in companies where things are replaced every year on an ongoing basis, or things are replaced every couple of years. So their depreciation also, depending on the accounting method that's used from the CPA of the seller, this will spread the cost of expenses over time. It may be a straight line depreciation, it may be accelerated depreciation. We don't really get into that as business brokers when we're doing a recast of financial statements, but it is something to note that oftentimes when we're talking about capital expenditures and depreciation, they're not always in the same time period. So hopefully that makes sense. But we're going to talk about what we do with that and how we calculate our CapEx number and the depreciation as well. So let's take a real life example. And I'm actually using real deals that I did. So if anybody has specific questions. So this was a particular company, and they was a door manufacturer. So you have obviously an assortment of vehicles, and some of those have lower mileage, and they're newer vehicles. So obviously they're going to be replacing those at different time periods, or maybe they're going to be investing in the company because it's growing and adding new equipment or whatever that be to produce the profits that the business makes. So what happens when the business owner needs to replace a vehicle, for example? So we're taking vehicle number 13. So if you saw back there, it had like 100,000 miles on it, or 150,000 miles on it, sorry. And the seller decides this needs to be replaced to reduce the ongoing maintenance expense that it is to keep up that vehicle. And then he's also going to go to market to buy a replacement. So he's going to buy one for 100,000 and he traded in his old truck for 30. So sometimes you have where they're investing in new assets, but they actually are selling off old assets. And we'll talk about how we account for that as well. So how is this going to show up in the financials? And the reason why we want to do this, I want you guys to start thinking about the actual activity that's happening, not just, here's the formula and here's how you do it. So how that would actually show up in the financials is both on the P&L and the balance sheet. So the P&L, you're going to have an other income and expense because he's got a gain or a loss on the sale of assets. And I believe Treef actually told me recently about, it was a boat rental company, I believe, that the seller had claimed the sale of his assets in top line revenue. He's back.
Right. So, oh, here I am. So what we were talking about is there was an actual boat rental place where they had to replace the boats, like 25% of their boats every single year. So what they would do is they would sell the boats, the old boats, and they would actually count it as revenue. And then they would, take those monies and they would buy new boats with it.
Yeah. So that's actually probably not what they should do. It should be on the other income, but you're going to see sometimes where those activities show up in top line revenue. So taking into consideration that that particular company did it every year, I would leave in that they were going to recapture some of that money back on the asset.
Right, for sure.
And the same thing, I had a pool company before that every 3 or 4 years, they would sell off a route from their service route. So that activity, even though we're taught to just take out other income and expenses on the P&L, sometimes you don't need to do that. So in the case of a vehicle replacement that's constantly being done, you want to recapture that sale somehow on calculating that. So the other place it'll show up is depreciation. Obviously, we talked about that. I think we're understanding that a equipment or a piece of equipment could be accelerated. It could be straight line depreciation, however that shows up. We're automatically adding back depreciation. And then on the balance sheet, when you sell an asset that has been completely depreciated, at least from a books perspective, and you're getting back some of that, you might have recaptured depreciation. So, and then your FF&E will change because the value of what you already had has been depreciated. Now you're buying something new to replace it. So that's how you kind of see both of those financial statements have this activity show up. All right. And then obviously how we account for these regular CapEx activities, we're going to deduct them from the cash flow we're advertising, whether that be SDE, seller's discretionary earnings, or adjusted EBITDA. So a lot of times when we get into these bigger businesses that have a lot of assets, we're not advertising just seller's discretionary earnings. So either way we're doing it, we're taking it out of the cash flow.
Perfect.
Okay.
Hey, by the way, if you guys have questions and stuff, type them into chat and we'll answer these things as we go along here.
Yep.
So, just type them into chat. Megan will get them to us.
So how do we recognize when it's important? I mean, CapEx is important no matter business, obviously, if it's there, but how do we kind of teach ourselves a rule of thumb, right? Go and we walk around and we visit the owner, we look around, we see a lot of equipment, right? That's going to be an obvious. And then you also look around and see how is that equipment maintained? Maybe this everything's pretty old. There's going to be a future capex that needs to happen. Maybe the seller's historical is not reflective of what really should be there. These are all questions you're going to have to ask yourself. And I always say, look at yourself in terms of a buyer and what a buyer would say. So if you're looking around and you're like, yeah, they haven't spent any money, but that's going to be necessary, then the future cash flow is going to be a lot less, at least for a couple of years, while that business kind of gets caught up to speed. I would say also, if you notice that there's large amounts of depreciation every year, it's probably a sign that there is a significant capex number. I would say 200,000 above. What do you say?
Yeah, I would think somewhere around there for sure.
Okay. Um, Depreciation and capex, like I said before, not going to line up in the same year most of the time. So you can't really use that as the number. You can also ask the seller, get a list of the equipment purchases that they've taken, but we're also going to show you where you can find these in the financial statements. So common industries where capex is significant, and this is where I do want to hear from the group. If you can start to use the chat box, construction where you have underground utilities, paving, things like where there'll be significant equipment, diggers and haulers and stuff like that. That's going to be really that heavy machinery. A lot of manufacturing, even though you might see a contract manufacturer. I actually sold one that had no capex because their clients, their customers actually produce the equipment they use. So it's not like they have to have it, but you always want to ask the question. Automotive, manufacturing, steel, equipment, things like that. Trucking and logistics is a big one, but I know in trucking and companies, sometimes they do not buy their assets, they actually lease those, or the drivers actually have their own vehicles. So you have to ask the question. Mining, agriculture, food processing, distribution is also another one, and equipment rental. So anybody else have any that they want to share?
We have one limo business.
Okay. So transportation.
Limo came up again.
That's-
Surveyors, restaurants, question.
Yeah, a limo business is a classic example where they have to buy new limos every couple years. If they got a big fleet and they have 20 limos, they might have to replace 5 of those limos every single year. So you're really not going to be able to count a lot of that depreciation because that capital expenditure is going out there every single year in and year out for that. And remember, at the end of the day, what we're trying to get to is how much cash does the seller actually get to keep every year? And when they're having to take a lot of their depreciation and just rebuy equipment with it, they're not getting to keep that cash. And so we're trying to get to that point of what do they actually get to keep? What's their actual cash flow?
Yep.
So we have surveyors, restaurants, question mark.
I think restaurants, maybe an initial equipment would probably be significant, but I don't think you're going to see it too
Yeah,
much.
I think for the most part in restaurants, you can just count the depreciation straight line because you don't have to buy stuff on an ongoing basis. You buy a walk-in freezer,
Yeah.
for example, it might last 20 years. You're not replacing that on an ongoing basis.
Construction equipment rental.
So any equipment rental business, right? The sheer idea of renting equipment, people are going to beat it up. It's going to be something that has to be replaced. Like you had the boat rental
Right,
company.
right.
Limousines are kind of similar because they're renting out the time in a limo, right? You have equipment like construction equipment. That stuff gets beat up, it gets replaced, and that is the cash driver of the business. If you don't have that, you can't run the operation.
So, like a lot of limo companies, because came up a couple times, in a lot of states, they have to replace those every 4 years because they're not allowed to use them in service once they're a certain age.
Right.
So they're always having to replace those limos.
Yep.
There's a question, IT, computers.
Yeah, so IT could be if there's so much equipment that obviously continues to have to be replaced or upgraded because they're in the nature of, IT business. But when you think about, I guess information related businesses, I don't see CapEx too much.
Yeah, not so much. Like in today's environment of AI, if there was like a server room or something where they're having to update their AI computers with their new NVIDIA chips every year, and to just to keep up with the Joneses, and then you probably would have a CapEx issue.
Right.
What
But-
about medical practice?
Like if you think about similar to a restaurant with MRI equipment, things like that, it just really depends if that particular industry or practice needs to have constant replacement.
Right.
But again, if it's just one time in the beginning, then you're probably not going to see depreciation hit the P&L every year.
Like she brought up MRIs. If you're in an MRI center and it's huge and they've got 10 MRI machines and they're having to replace an MRI machine every year or two every year, then you're going to have a CapEx issue because
Right.
that's a reoccurring capital expenditure.
Yep.
And then
Exactly.
we have a question.
Yep.
Selling a large manufacturing company which has been upgrading equipment over the past 3 years to prepare for expected higher production needs, expected revenue growth. This investment could be argued to be an investment in better, more efficient equipment to achieve higher sales rather than simply replacement of older equipment that has reached end of life. Agree or disagree?
So I would treat that as a multiple driver versus something to do with CapEx, because if they made an investment on the future profits, kind of like that first point I talked about, that the potential now the business is set up there, are they already realizing sales? Are they already doing that? You may have bought this really great equipment and then you have no customers that actually need it. Is it of value? No. But if you've already started and you've got contracts and you've demonstrated it, but an ongoing nature of replacing that equipment you would only look at the CapEx needed in the future. Hopefully that answers.
Yeah, I think it does. And I think it goes back to, hey, you went out and bought a bunch of new equipment. Are you going to have to replace it next year and the next year and the next year and the next year? And if it's consistently having to be replaced, then the answer is it's capital expenditures that are ongoing. If it's one-time investment and you don't have to replace it, then you could probably just depreciate it.
Yeah, we're always trying to use historical financials to predict future benefits, right? If we're looking at it from, hey, it's already done and it doesn't need to be replaced in the next few years, then maybe the CapEx number you could average out over time isn't as significant as it was historical, but there is going to be some number in the future.
I think maybe hit on the large amounts because there's a couple of people throwing things out that are smaller.
Smaller numbers?
Replacing like medical gloves or uniforms, things like that.
No, those
Disposable?
yeah,
No.
those are inventory costs.
Yeah.
Those aren't, medical gloves, things like that. Those are inventory costs.
Yeah.
Those are already expensed right in your cost of goods.
Yep.
So we're not talking about, cost of goods expenses here. We're talking about depreciation and how we're depreciating the capital expenditures.
And we're not talking about repairs and maintenance either.
Right.
So if they're fixing equipment, is different than buying a new piece of equipment, right? So the repairs and expense categories where you're going to see things like oil changes and whatever. But if they're going to go physically replace the vehicle, that's what we're talking about.
Right.
There's a question that says, so if they are replacing the equipment annually, then we should not add the depreciation back, right?
No. We're going to get into what to do with it.
Right.
But the depreciation and CapEx are related. They're not the same thing. Okay. Good.
Yeah, I mean, there's one long paragraph.
So kind of the short answer is you still get to add the depreciation, but you have to add the cost of the capital
Deduct the
expenses,
cost.
deduct the cost. Yeah. Deduct the cost of the capital expenditures out of your earnings. So
Yeah. And we're going to show you the examples.
yeah.
We're going to go through a couple of them. Okay. Sorry, we're getting there. All right. So I always ask the seller first, and then I take a look at the tax returns, or I try to verify. But this is a form 4562. It's on the seller's tax return, depreciation amortization report. If you use the most recent year, obviously it's going to tell you all this stuff that's still that they're still using. And you're going to look and see everything that they've acquired. So the date in service. So that was the year that 2024. And then we had total 2023 at the bottom. We have 22, 21. You don't have to look and squint your eyes because I went ahead and totaled all these for you. This particular company, so you have 24, 23, 22, 21, and 20, right? So you kind of see some low numbers, high numbers, look at a 5-year average, what do we do with this? So I gave you more information in the next, the table. So you have top line revenues, you have net income. I basically gave you a shortened, condensed version of a recast. What the officer comp was. We add back interest, we add back depreciation, and then personal items, things like that. So we get to the total at the bottom, which we would call seller's discretionary earnings, right? Because that's the officer compensation added back. And then there's the salary adjustments, actually a negative number. So that's because I was calculating adjusted EBITDA since the buyer was going to be a strategic. But the CapEx number, if you look, it changes over time. But if you look at the top line, we went from 12 million in revenue to 18 to 25 to 27. So what happened here? Does anybody want to give me a couple of suggestions? I know I'm not supposed to ask questions.
Oh, ask the question.
What do you think was happening? Why was their CapEx number getting larger? It's kind of a good, can kind of figure it out. They were producing more revenue, right? So their activities of investing in more equipment was because their company was growing.
So we have spread over a few years, expansion, free ERC money, expansion.
That's actually funny.
We're not talking about where they got it.
We're not talking about ERC and PPP. But, basically the answer to the question is they were buying equipment, and because they were buying equipment, they were able to expand their business and produce more revenue.
Right. So now going forward, the more recent numbers are probably more likely, right? So you can see we're 22. They had an off year. I happen to know this is a pool company. It's a pool construction business, and they got hit with supply chain. I always ask these questions because you're going to get asked, so it's good to know. They got hit with a lot of supply chain issues, and they didn't have escalation clauses in their contracts. So they were performing work at obviously you can see at almost a negative. But they wanted to protect their reputation and finish those contracts to keep their reputation and their brand and protect that. So they did that, and it was the right move. So they ended up investing in equipment, and they grew, almost doubled their business in a very short period of time. So it's sometimes good to look at more than just 2 or 3 years and really ask the questions to find out what's going on. So, hold on. This one is a concrete manufacturer. So a little bit different scenario here. And I told you guys, these are all my real life examples of businesses. So they had 22, 23, 24, and 25 annualized from April statements was pretty consistent, right? So top line revenue is about the same. The interest and depreciation all over the place. Now, obviously the 2025 annualized is from a P&L. So it looks like their accountant comes in and does the depreciation at the end of the year. That's why you don't see a lot of it in the P&Ls. But now we're looking at significant CapEx every couple of years. Anybody have an idea of what's going on here? Possibly. Okay, well, I will tell you because nobody can talk. They're buying those big concrete barrel trucks, whatever you call them. Mixers, yes.
Mixer truck.
Every 3 years. So he has to replace like one truck every 3 years to maintain that top line 7 million-ish in revenue. So if I took CapEx and only averaged 1 or 2 years, I'm not really getting the full picture. So you really have to look and see how much money they're having to invest in over that time period. And for this one, I definitely would take an average because their top line revenue is staying the same. The bottom, CapEx is just to maintain and keep doing that with the equipment.
So when you do that, Aaron, I'm curious because you're taking the 3 years like you took 22, 23, and 24. In this case, where the revenues and things were about the same, are you taking the average EBITDA as well?
Yeah, for this company, yeah.
Purchase price?
So in the previous company, this one, the seller wanted 9 million off of roughly 2 million in EBITDA because he said, hey, we're going to keep growing. We are continuing to grow. So what we did here is we actually said the value of the company right now is probably about 7.5. We'll tie that rest to an earnout, and the EBITDA has to produce this going forward. So it kind of protects the buyer and the seller of, overpricing the business. We don't want to get into that. So that's actually how this one was structured. Now this one, it was a straight line average. You could maybe carve out 22. There were a lot of supply chain issues, so you can see his net income was, kind of off that year. And it really wasn't off in 24 because he paid himself. All that officer comp was actually there versus 22 where there was a smaller officer compensation. So that's what I would do.
Yep, I like it.
Question.
Okay.
When they sell their assets, example, car rental, is that considered income?
So if it's something that happens all the time, that's what we're talking about in the beginning, then
Yep.
you include it. So like the boat rental company, they sell the boats every year. So
Right.
that money comes back to them. It's used to purchase the next fleet. So your delta is not as big as if you were just including the equipment every year.
Yeah, it's kind of an accounting thing. When you have a vehicle, for example, and you put it in there, all you can write off is the interest. You're not writing off the principal payments, right? And so the depreciation is the way you write off those principal payments. But if you fully depreciate that vehicle and then you sell that vehicle at zero value, then it gets treated by the IRS as regular income. So it basically, one way or another, it ends up in the revenue line.
Now you had somebody who said that they sold vehicles or equipment for cash, like
Right,
personally.
right. So this was actually a few years ago. It was a trucking company. It was a dump truck company, and he was replacing his dump trucks every year. And what he was doing is when he would sell the dump trucks, he was not accounting for, they were fully depreciated. He was not accounting for the sale of the truck, and he was just putting the cash in his personal pocket. So we were actually able to go in and, prove that and add that back to the revenue line, which added to the EBITDA
But it should
considerably. It shouldn't be that way.
be on the P&L.
Right. It should be on the P&L for sure.
But ask the questions. Again, we're taught to not just follow formulas. You always have to ask the question, what's going on here? So why is your CapEx all over the place? Or, why isn't the other income that should be here? You told me you sold a vehicle. I don't see it here. Ask the questions. That's really what it's about, to kind of try to understand what was going on.
Another question.
Yep.
What do you do if CapEx has been occurring in past years to facilitate growth, but is not anticipated currently of the next few years?
Is that from the seller? Because the seller might get it and just try to like inflate its price and be like, okay, well, that's great, but I don't know if anybody's going to sell it. A bank certainly is going to want to know what
So
historical
this
is.
is actually the question I just actually called Aaron last week on, is I had a bunch of capital expenditures 2 years, and then the last year we had none. And, and we talked about how do we handle that? And what was your answer on that? We average it out, right?
Yeah. Yeah. That's why you take a longer year average. All right,
Right.
Mr. Seller, you didn't do it last year, but you have 4 other years of doing it. Let's just take the average and, it'll wash itself out. Most of the time it does average out.
Right.
Doesn't adding back CapEx to arrive at adjusted EBITDA fall outside of the very definition of the EBITDA, whereas CapEx expenditures is more of a matter of cash flow?
So you're just doing this from a standpoint of basically figuring out what you're going to suggest a value is, right? So a bank is going to ask this question too, because they're going to look at what is the actual cash flow the business has available to service the debt.
Well, keep in mind too, because that's an accounting question, but EBITDA is before depreciation as well. So, if you're looking at a true EBITDA number, you're not doing the add back to depreciation either.
Yeah.
So, you got to kind of, on these big deals, you got to think of them as a tandem kind of project.
Yeah, and it's adjusted EBITDA.
Right, right.
So we make adjustments to basically advertise what the true cash flow of the business is, depending on who the buyer is. And it doesn't really matter. The price doesn't change if you're calculating seller's discretionary earnings or adjusted EBITDA. Just the multiples change based on the buyer. So somebody who's a strategic is going to pay a higher multiple than somebody who's going to operate the business, because there's that time value of money. If I'm working in the business, I should make more money. So it doesn't really change when you look at the overall outcome of what the price will be that it will sell for. So in this case, what would SDE be after CapEx? Because I gave you what adjusted EBITDA would be. So in this case, if we're calculating seller's discretionary earnings after the CapEx, you'd be taking that line, the second from the bottom line, and subtracting it from the SDE to get that number. So hopefully everybody understands that. You just aren't including the salary adjustment.
And the reason this is important, guys, because if you don't subtract that CapEx out of there, you're going to have an SDE of 2.1 million, and you're going to be well overpriced.
Yeah.
And on these large deals, I mean, you have sophisticated buyers. These are, people who understand these things, and they're going to go, hey, why are you asking $10 million when you should be asking 7? And
Hmm.
you didn't do a CapEx adjustment. So,
Right.
you know, these aren't restaurants. These are, large
Hmm.
large transactions. Sophisticated sellers, well, not always sophisticated sellers, but the buyers are usually sophisticated.
And I've noticed, and I've heard this from sellers, well, I always put money back in the business. That's what this means. Guys, that means the seller's going, I always kept growing my business. I kept putting money back in. That means that he's investing in equipment and he keeps trying to put it back in the business, not take it and just put it in his pocket. That exact phrase, you hopefully you pick up on it. Now you know that's CapEx. Um, Using a balance sheet. So you're estimating CapEx by using the ending net FF&E minus the beginning net FF&E plus depreciation. And you have to have year-end balance sheets. And then you have to have the P&L for the depreciation. And basically the formula works because depreciation reduces the property, plant, and equipment. So if that number is still increased after subtracting depreciation, company must have acquired new assets. However, if they are using or they have significant asset sales, it's not the recommended way. But you can also look at cash flow statements too. Any questions or comments on that one?
Megan, do we have a question up there? I see.
Yes. If the business sold a piece of equipment, the gain or loss may appear on the profit and loss statement, but it shouldn't be removed during normalization for valuation purposes.
That's what we were saying before. If it's something that happens regularly, yes, you shouldn't, you don't need to remove it.
Right. You're counting it because you're subtracting the new capital expenditures.
Yeah.
There's another question. How does depletion play into CapEx and depreciation?
Depletion?
I don't know if it was a typo, but that's what it
No,
says.
that's not, I've seen it on tax returns. I don't run into depletion that much. I
Yeah.
think I've seen it once.
I would say
And they
I've seen
put
it.
the wrong
I've seen it
category. It
maybe,
was
I've seen
actually,
it maybe once or twice ever. I don't have an answer. That's a
it was
better
actually
CPA.
supposed to be depreciation. The accountant put it in the wrong
Ah,
box.
there you go.
I think you're going to see that with like oil and
Yeah.
gas and
I would
stuff.
say depletion is an asset, like an asset like coal or oil or something like that. Here in Florida, all we have is sand. So, so I've never seen it, to be honest, but
Yeah.
I've seen it. I've seen it like in coal mines and things like that.
Mining operation.
Yeah, it's a mining term. I would tell you it's a better question for a CPA, and it just doesn't come up that often. So I don't have
Yeah.
an answer for
I've
you.
never ever encountered it. So any others? All right. So back to what Tree was saying, if you're not accounting for proper CapEx and the true cash flow, you're likely setting an expectation for the seller way beyond. So in the last example of the concrete manufacturer, if we were basing the price off of a 4 times multiple of the 4-year average, and we didn't subtract CapEx, we're recommending a price of 8.2 million. Same multiple, but factoring in CapEx, that's $2 million less. So it is very significant. And like I said before, banks are going to pay attention to that. So you're not going to get an $8 million valuation. Maybe you'll get somewhere north of 6, but it's going to get dicey if you're not factoring in the CapEx when it's significant.
So I have a question for you. You brought it up briefly earlier. When you have a business that hasn't been spending capital expenditures like they should have been for 2 or 3 years, and their fleet is wore out, and the new buyer's going to have to come in and buy all new trucks, or they're going to have to buy all new equipment and stuff. How are you adding that CapEx? How are you doing that? Are you doing it like based on a 3-year average, or are you doing? You're clearly not doing it just one year.
No. What I would say is I would look at the multiple, first of all, is going to be a lower multiple, right? We always say if the assets are, not that great, then you're not going to get a premium. So the multiple of the historical is not going to be great because you're factoring in that future. And I would also try to find other similar businesses that maybe you can see what their number is, similar sizes, and try to figure out from there what the going forward is. take a look and see, are there 10 trucks? How many of those trucks need to be replaced or whatever that looks like, and start to do a little research to figure out going forward, or maybe the initial investment is going to be significant, but then over time you can spread it out and make it a little bit less. But I would say the multiple that you're going to pay is probably going to be the most affected.
Okay.
If large equipment is only to be replaced one time every 10 or 15 years, should you still average it over that time?
I would.
Example, a CNC machine, which
Mhm.
is not being replaced often.
I would say that you would have to factor in something to set aside for future, because that's probably what the seller's been doing anyways, is, they know they're going to make an investment in that piece of equipment, and they know, all right, every year I got to set aside 100 grand, 200, whatever that is.
So look, for pricing purposes, I would probably make the buyer do that. Listing it, I probably wouldn't throw it out there.
Yeah.
I would probably make the buyer do it on something that was that long of a time frame.
Mhm.
Because, look, I mean, if they bought that piece of equipment 14 years ago and they're gonna have to replace it next year, then that's gonna be a big thing for the buyer.
Yep.
And so I would probably put it out there when it's something like that. I probably wouldn't worry about the CapEx add back or subtraction, and I would just make the buyer do it based on their own. Sometimes, when it's just not completely obvious, you kind of force the buyer to.
And most of the time they know that they're looking at something that, hey, all right, I'm willing to pay this for this business because I know I've got to put more into
Right.
it, that kind of thing.
And
So
that could come back to what Aaron just said. It might just sell at a lower multiple because the buyer knows they're going to have to buy that huge piece of equipment in the next 2 years.
Can you explain again how you got the CapEx amount for each year on the concrete deal? Do you average over the last 3 years, then deduct the difference each year?
So the CapEx number for here came from the broker, and then the 600 grand was actually hadn't been done yet. The seller told us I have to buy that equipment this year. So that's how I knew the 600 was going to come off. And so that's how I knew that particular company. I represent the buyer. So I asked the selling broker to put together a list. The selling broker is business partners with Monty Walker, so I trusted it.
Right.
So
Yeah.
yeah. So what was the other part of that question?
Um, so do you average over the last 3 years, then deduct the difference each year?
I said for this particular company, I took the 4-year average because the top line revenue didn't change. But you could weight it. You could do, 30, 30, 30, and 10 in 22, because 22 looked like an off year, probably because of supply chain, like I had said, but he still had to make the investment in the equipment. Is that what you would do?
Yeah.
And then I think this is related to the 15-year example of the CNC machine.
Mhm.
With that example, would you see what the payments for a loan to replace that equipment would be?
I wouldn't make an adjustment for it. I would be prepared to answer some possible scenarios for acquiring that for the buyer, but I don't think I wouldn't make an adjustment for it.
No, I wouldn't either.
Another one. Wouldn't a business owner likely finance the large periodic CapEx expenditure so the payments will be part of operating expenses?
You could do a deal structure where there's an owner note, like a seller note. Is that what we're saying?
No idea.
Okay.
Can you reread that question?
Reread it?
Yeah.
Wouldn't a business owner likely finance the large periodic CapEx expenditure so the payments will be part of operating expenses?
Oh, absolutely. They finance it all the time, but just because it's finance, you're still depreciating it. You might have your piece of equipment fully depreciated, but you still might owe $80,000 on it.
Yeah.
So that's the trick is you're not depreciating the capital that you actually spend on the loan. You're depreciating, based on the federal depreciation schedule. And I mean they might buy $100,000 truck and depreciate all of it in 1 year, but the loan might be
Mhm.
5 years. So there could still be capital owned. So that's why that.
And when they
works
sell
like
it,
that.
that's why you recapture depreciation. That's why it
Right.
changes. And that's why, although depreciation and capital expenditures are related, you can't use one versus the other to figure each other out.
Right.
Okay. Well, final thoughts. That's my last slide. Oops. And final thoughts.
I mean, we got like 15 more minutes here. If other people have some more questions, let's jump in and ask those.
So couldn't an investment in new, more modern equipment that may reduce costs while increasing production be an offset against the CapEx?
So you're saying the potential drivers. Well, if you're selling, I would say if you're selling at a premium, then yes. If you're just trying to sell, at a normal multiple, then you wouldn't have to.
Well, yeah, I think maybe what they're going at there is where the equipment is very old and the new buyer's gonna have to go buy a bunch of new equipment. I mean, you might be able to, I mean, it's a stretch because you really don't know, but look, if it's going to get a new piece of machinery is going to reduce your cost of goods by 10%, for example, you might be able to do some sort of adjustment in your cost of goods and an add back. But I think that would be probably above where we should be going as brokers, to
Yeah.
be honest.
Yeah, you don't need to go crazy.
I think that's more for an accountant to do with, quality of earnings and things like that than for us in a recast or
Yeah.
a broker opinion of value. But I mean, there is some of that for sure. Look, you buy a new truck and all of a sudden your gas mileage is 30 miles a gallon instead of 10, your fuel cost is going to go down.
Yeah.
But, is it going to go down significantly? Maybe a couple grand or something, but I don't know that we're qualified, as brokers to make those kinds
Yeah, I think
of
the
calls.
big takeaway is we're saying if you miss it and there's significant, it's going to be a very hard sell for both sides
Yeah.
because you set the seller expectations and that's what our job is. And if we don't do it right, then we're up here and it's really going to be here. Now there's a gap.
Would you pay off the equipment at close or would you keep the financing? My excavation company trades and buys new equipment every 2 years.
So that doesn't change the recast. That just is the debt structure that
Right.
buyer and seller are able to do. So most of the time, especially if there's a bank, they have to pay off the equipment. If there's an assumable piece of financing, then you set them up. I sold an embroidery screen printer and it was assumable, assignable. So we
Right.
did transfer that. In that case, you take the interest out if that is the way.
Right. It takes your interest add back out. You added back your interest because we're assuming the buyer's going to get that piece of equipment free and clear. So if they don't get it free and clear, then you can't take that interest out of you can't add that interest payment back because they're still going to have it. And keep in mind, if they assume, a note on a $50,000 piece of equipment, you still get paid on that 50 grand. So make sure you're charging. Make sure you're charging on that stuff.
They said thank you. What about lease payments on the P&L? Would you add back? Lease is paid off at closing. Example, truck has 10-year life and a 5-year lease. Would I add back the lease and post a CapEx average negative add back?
I would add back the lease payments.
Yeah.
Yeah.
I do it like
Yeah.
dishwashers or something like a restaurant equipment, like, stuff like that's going to be paid off at closing or it has to be to transfer it over and that there's still value left. Yeah, I would. But if they have to continue a lease or replace it, then you would want to
Right.
keep it in.
I mean, and the other part is you don't know what they're going to do with that lease at the end. They might just buy the piece of equipment at the end. There might be a buyout at the end of the lease for,
Like the
$20,000 or
whatever.
something.
Yeah.
Yeah.
Mhm.
So it's hard to judge what the buyer's going to do at that, 3 years from now or 5 years from now, what they're going to do with that equipment. They might keep it. They might sell it and buy new equipment. I don't know.
This one's a long one. I've run into an excavation business that have a lot of expensive heavy equipment, but also have a lot of debt. Paying off that debt on equipment that has a lot of life left that the new owner gets benefit of means the seller gets a much lower exit. Do you see those loans getting assumed given the debt UCC need to be removed to legally transfer the assets?
So I will tell you on large pieces of equipment like a Caterpillar or, things like that, a lot of those are assumable. When you get into the heavy equipment financing, a lot of those are assumable. But, I would tell you, if you're having to buy the equipment, your multiple is going to go down because one of the reasons the multiples on those are so high is because they're equipment heavy. And if you're not getting the equipment free and clear, your multiple is going to go down. Your price is going to go down.
And sometimes the assets are worth more than the income they produce.
That's for sure.
Okay. Just going back to some older ones because there was one Treeview might ring a bell with Jason Curcio. The cash flow of the survey company we spoke of this morning should be adjusted because there's $700,000 CapEx expense immediately post-purchase? Question mark.
Yes, the answer is yes. But I will tell you, does that have to happen? I know Jason Curcio's um, situation, it doesn't have to happen. He's talking about it because his buyer is going to hire employees and have to buy their own trucks and all these other things, and they're going to have to spend all this money in CapEx, where the current seller subs out all that work, doesn't require any of that stuff. And so that's really a buyer issue more, because the new buyer could just continue to sub out. So I don't know that I would adjust it.
You said the seller has no equipment.
Right, right.
Yeah, I
Good.
know Nate from a long time ago used to do these recasts where he would recast based on a strategic, recast based on this. So you might create a scenario separate for that one
Right.
buyer that says, here's what this, but you're not going to have all the subcontractor expense. So you
So
carve
look,
that out.
buyers always have to do their own recasts. It's really no different than when, like Aaron does a lot where they're investor purchases and it's not an owner operator purchases. So she's having to do a negative add back to owner salary because now she's having to pay somebody. But that's just for her buyer. That's what the SDE is. But if as an owner operator, that SDE might be 150 grand more. And it's the same with, Jason's example. His buyer's going to have to go in and buy all this equipment, all these trucks and all these things, but for another buyer, they may not have to. So you can't really, you know, guess what the buyer's going to do. Yeah, I guess all you can really go off is historical.
Yeah.
Will you email out the formula for completing CapEx?
Yeah. I mean, you can send it.
Yeah, we're going to send out the entire presentation to everybody.
Yeah. If you look at that, it's right here. Total SDE net plus add back salary adjustment. That's if you're doing a replacement over owner
Right.
and CapEx. So if you're just taking out SDE, you don't have to do the salary adjustment. So just add back 150. It's pretty
And
straightforward.
that's the example I just used where
Mhm.
it's a private equity group and they're having to hire someone to run
Yep.
it. So there's a negative salary adjustment back.
Yeah.
So,
And then the balance sheet formula is on here too. Oh, no, sorry. Oops, went the other way. So the balance sheet estimating CapEx is here. So that's the formula. So they're in the slides. Perfect.
Seller says equipment is fine and has useful life 5+ years, but buyer is saying it needs to be replaced. How would you handle that?
That's up to the buyer and seller.
that's why we negotiate for a living.
Yeah.
Yeah.
Well, and seller wants X and buyer wants to pay Y. So you got to figure out X point Y.
Nothing else coming in.
All right. Well, perfect. Thank you very much, everybody, for joining us today. Thank you very much, Aaron, for coming in out of your busy schedule and spending time with us. Megan will be sending out a copy of the presentation as well as the video so you guys can watch it some more. I got a feeling I'm going to get a million calls from you guys. So thank you.
There's a thank you. My head hurts now.
Yeah, for sure. For sure. Look, this is high level stuff, guys, though, and that's why we're trying to teach it, because we these are large commission transactions that sometimes that we lose because we're not taking these things into consideration, and nobody wants to lose a $400,000 or $500,000 commission because we just didn't know about this stuff or we didn't take these things into consideration. So
Thank you.
thank you, everybody.
Bye.